Good morning. Good morning. It is Tuesday. It's a calm Tuesday on the stock market. Uh, Not a lot of news happening this week, so I don't think there's going to be a lot of fireworks like last week, where you had the Federal Reserve having a presentation and making a decision on interest rates. We don't have a big employment report telling us how many people are unemployed. There's not a lot of news. So it's just, to me, a calm Tuesday. I'll take it. We're sitting on good gains in the month of September. And if we run out the clock in the month of September, it's going to be a good month for my portfolio. But things can change very quickly. I always think to myself, easily in a day or two, we can see all our gains go away. Not hoping that happens. I'm just being realistic that the market tends to surprise us when we're not looking, or when everybody seems to not expect anything. The market might surprise us. We'll see what happens this week. But for today, as of 30 minutes before the market opens, all the exchanges are pretty flat. No big deal. Oil is up 2%, up to close to $72 per share. We've been talking about oil stocks and how a few weeks ago they looked interesting because oil was in at $64 a barrel. Now it's $8 more. That's a pretty good increase. So if you were in oil stocks over the last couple of weeks, you really have enjoyed nice appreciation. And it was good that we talked about a particular industry that was being sold off, being discounted. That's really good. And let's keep bringing that up, that, hey, this particular industry looked pretty beat up and it may have a very good 2025. I'm an investor. I think, how can I make money over the next 5 years? And it'd be great to make money over the next 5 days. But over the next 5 years is really the goal. So let's keep thinking about what industries are really good to think about right now to invest, and then see our investment go up in value over the next couple of years. All right, Mike, good morning, sir. So you'd like to look at LQD and XLP and Poet. You got it. So I had all those noted, and I will start with those. So thanks for joining me this morning. Great to have you. So we have calm markets. Oil prices are up a bit. Interest rates on bonds. What's interesting is there's kind of a little bit of a misconception that the Federal Reserve completely controls interest rates. And that's not completely true. The bond market controls interest rates. And the bond market is made up of an open market of investors that say, hey, I'd like to buy a 10-year bond. I'd like to buy a 2-year bond. I'd like to buy it from the government. I'd like to buy it from a corporation. I'd like to buy it from a municipal government. That behavior of many investors in the bond market is bigger than the stock market, causes interest rates to go up or down. And this morning, bond yields are up. And what that means is that bond prices are down. So it's a day when I will buy a little bit more into ETF of bonds because I want to lock in a very good yield. I'm actually looking at an ETF where it holds corporate bonds that have a 10-year maturity. And I've been looking at one at a 20-year maturity. Now, this is what is considered a risk-free bond, which is with the government, the US government. If you go to the corporate side, you will at least get 1% to 2% better yield, depending on the risk level. And that's based on rating. So I'm, buying additional bonds to build up my long-term bond portfolio and lock in yields, desirably above 5%. If I can hit 5%, wonderful. Anything above that, gravy. But if I could lock that in, I think I'll be happy, because in a year, we may be sitting on interest rates that are 1 full percentage point lower, maybe even more. And in 2026 might even be lower. So if I locked it in at 5% for the next 5 years, I'll be, very happy I did so. So that's one thing I'm doing. Buying into ETFs is a good idea. And I think we're going to look at one today because you can get in and out fairly easy. Individual bonds are harder. When you buy individual bonds, you have to bid for them. You sometimes are able to buy it, sometimes not. Sometimes bonds are available and sometimes they're not. So ETFs for the long-term bonds is my preference because especially long-term bonds are very difficult to sell. So just word for caution, if you're new to bond investing, there's a couple of pitfalls, so to speak, or difficulties in the bond market. So that's what's going on. Looks like Sion Ken is saying that China market is ripping. So we're going to look at that. We're going to take a look at the ripping stock market. And it looks like Blackstone and Vista Equity Partners are going to acquire Smartsheet. Let's take a look at Smartsheet. And I want to talk about something else like acquisitions while I talk about that. So I'll note that for later. I'm going to go over the stocks that we want to look at as well as China, and then we'll get into that. All right. So the market is pretty calm. Not a lot of stories happening this week that I know of. So let's take a look at China. What's going on with China? So, wow, man. Whoa. Somebody decided to increase stock prices in China. Amazing. Okay, we'll take a look at that a little later. Let me jump into some individual stocks, and then I'm going to look at Alibaba, NEO, JD, Sion Ken. If you think there's another stock symbol you want to look at, please put it in the chat, and we'll take a look at it. Oh, cool. So I did see your post in Discord, by the way, and that's why I noted Baba, Neo, and JD. So thanks for putting that in the Discord. I appreciate it. All right, let's get going with Poet. So Poet Technologies. So Poet Technologies designs, develops, manufactures, sells discrete and integrated optoelectronic solutions in Canada. Company offers integration solutions based on the Poet Optical Interposer, a novel platform that performs seamless integration of electronic and photonic devices in a single multi-chip module using advanced wafer-level semiconductor manufacturing techniques. Okay. So they're in the semiconductor microprocessor industry. And I imagine, wow, they're tiny. Very small revenue of 116 million. They're losing money. They're new. They're a young company. It's a strong buy, according to analysts, but they're priced at a premium. Over the 1 year, they're doing very well, up 35%. And over the 5 year, it's still positive, but boy, they were doing really well a couple of years ago. And since then, the stock has really settled down. So, wow, in the pre-market, these guys are just flying. And yesterday they were flying. So there was probably some news that made their stock just go crazy. So they develop technologies that are going to go into AI networks. And they're collaborating with Mitsubishi in this particular example. So this may not be giving me all the news stories, but yesterday it ripped up 40%. It's a small price stock. Okay. Today it continues to rip up 7%. Amazing. Now the revenue, holy smokes. how come? So this was telling me we had $116 million, or is this literally $116,000? I guess so, because it doesn't have a little M. Okay. So this company is almost pre-market, pre-revenue, excuse me. And the revenue really dropped 85% compared to, the trailing 12 months compared to the fiscal year 2023. So they're really small revenue wise. And it's a pretty risky situation unless you really know that they're going to make it, or you have a sense that they're going to be acquired, or something's going on that you think uh, this stock price is really moving for a reason. I'm not seeing it. Of course, I've never even looked at this company, so everything's brand new to me. I'm not seeing where this company is really clicking, operating well. It's short of that. They burn cash on the operating cash flow. Overall, they're burning cash to the point of $19 million of cash is being burned per year. And how much cash do they have on the balance sheet? They have 21 million of cash on the balance sheet. They don't have any debt. So they have about a year of cash to operate with. If we look at their cash position compared to their burn rate. So what's going to happen to them? Is their technology going to be used by a major company or another major semiconductor? It most definitely could be. It's such a low price stock, and the market cap is so small that it could really move up fast. So if this is something that's interesting, I would study the company and try to get an information advantage and potentially capitalize on it. But it is a very risky situation. Those are not situations that I jump into. Um, I'd have to see a little more light at the end of the tunnel. I don't like seeing super low revenue that's going down. I don't like seeing negative burn on cash like they have. If they're it's not like they're brand new, right? They've been around for a little while, and if their technology was really good, oh, they were founded in 1972. Yeah, this is a total pass for me. It's interesting that their stock's behaving the way it's behaving, but if you were founded in 1972 and you're barely making any revenue and you're losing money and burning cash, something's wrong with this situation. You're a part of the semiconductor industry, but to me, the semiconductor industry is overpriced by a pretty good margin. So, interesting company. It's a pass for me. I think if you have an information advantage on this company, maybe that's your play, but it's not. It's not a good stock for me. Today, it's going to go up almost 8%. So, congratulations if there's a stockholder out there that owns this stock. Man, you've made a fair amount over the last couple of days, and it looks like from Mike's comment, since April, it's up 145%. That's pretty darn incredible. Pretty awesome. All right. So Scion Ken, I'm going to note that I'm going to look at BFLY. Never heard of it. And we'll take a look at that. All right. So let's look at LQD. Okay. So now we're looking at an ETF, investment grade bond ETF. So let's take a look at this closely. This is fixed income. This is really a collection of bonds and investments that are going to create a yield. They pay dividends. We'll take a look at the dividend rate. So 1 year return has been 9%. Not bad. This is low risk, much lower than stocks. And it's paying a dividend of 4%. So you have a lower risk investment. And think about, so depending on where you are in your investing journey, right? If you've been investing for a while, you've been collecting, savings and building your wealth and your net worth for a while, and you've got a very good net worth, you're playing a little defense. You're seeing, okay, I still want to invest in equities. I still want to invest in stocks. It's something that I like doing, but you don't want to bet everything on stocks. You want to preserve some of that, wealth you've created over the many years that you've been working. If you're maybe newer in your investing journey and you're like, hey, I just want to accumulate, wealth as fast as I can. I want to have the highest rate of return. Those are two different perspectives. The perspective of the new investor, you're really electing for high growth. Hey, let me grow my assets as fast as possible. And those you can get very creative with stocks, especially if you could find growth stocks that perform and can really double your money very quickly in 2 years. And then you're really increasing the rate of return on your portfolio. The downside of that type of, all out equity portfolio is you may have years like 2022 where your portfolio goes down 25, 30%. It's pretty demoralizing. As opposed to when you invest in bonds, they don't go down 25%. A bad year, they go down 5%. That's a bad year. Good year, they go up 5%. It's a very stable investment and it pays out a dividend. So bonds tend to achieve a 6 to 10% rate of return, really steady. They're pretty darn boring. And if you're at a point where, you've accumulated a good amount of wealth and you want to kind of separate a part of it and say, this I want in a lower risk tier, that's where bonds come in. And I could also see how, we have dividend investing, and dividend investing in a way is easier than looking for a growth stock. Growth stocks, you got to understand that industry, have a lot of qualitative, analysis and decision making, and be able to value that company and then make a decision. A good dividend stock represents itself with its dividend. Hey, we've been paying 3%, 4%. We're a dividend aristocrat. There's even like a prestige to that. And that means that they've raised their dividend for a long time. That's all fine and dandy. But if a dividend stock, let's go with one of the most famous ones, which is Coca-Cola. I believe it's an aristocrat stock. And it pays a 2.7% dividend. And this is a good company owned by Warren Buffett. Your rate of return for 5 years is 32%. That's not very good. That's 6% per year. And that's compounded. It's actually less than that. But I'll go 6% just for the example. 6% plus 2.7%, we get to 8.7% rate of return. And Coca-Cola's had its ups and downs. It's a very stable company, but at certain points you had, the stock go down 16%. So you have adversity and volatility. A bond issued out from Coca-Cola, I would venture to guess it's going to do about the same rate of return, but you're going to have lower risk. So that's the difference between bonds and stocks. And, I think if you're an investor and maybe you're 40 years old, let's use that as kind of a stake in the sand. It's a really good idea to get really familiar with bonds and begin to get good skill set around bonds, because when you reach 50, I think bonds could be a very good place to put some money away where you're like, hey, I want to lock this in because I have a son or daughter starting college. I want to lock this in because I want to buy a vacation home in this area, and that's where I want to retire in 5 years or whenever it'll be. And bonds could really be a really good investing asset class that you can put money in. So let's look at this ETF and see what it's all about. So it pays a 4.8% dividend. It's appreciated nicely over the 1 year. So if we look at the 1 year on LQD, so it did about 10% for a year. And then you got to add the dividend, right? So it's a pretty good return on a corporate bond. Now, let me take a look at, I'm going to look at two things with bonds. It's far simpler than stocks, but you want to look at um, risk level, which is going to be achieved by looking at the overall rating of the ETF. And you want to look at what type of term do they buy these bonds in? Is it a short term? Is it a long term? And I'll provide some comments there that I consider when I look at bonds. All right, so let's take a look at, I don't think these guys are going to get me there. So it's LQD. All right, so now I'm looking at the data sheet for this particular ETF. So the duration is 8.5 years, and that's important to consider. This is in the area. This is, in my mind, it's a long-term bond portfolio, which is fine. 8 years. You're locking in a rate of return of roughly, if you look at the dividend, a little over 4 for 8.5 years. Now, these guys will continue to refresh their portfolio. So 2 years from now, it's not like they're going to be sitting on the same bonds. They're probably going to sell some bonds, add some bonds. So the trailing yield is 4.18. Average yield to maturity 4.76. So this looks good. This looks good. Let me compare it to another ETF. So it's a good ETF, and I kind of shared why I'm investing in long-term bond ETFs as well as, individual bonds. I've showed my bond ladder in the past, but there is an ETF that I'm currently investing in, and I'll probably buy some more shares in later today. Let me take a look at the symbol. So this is the ETF that I decided to invest in. It has a nice dividend yield. It has a good mix of corporate bonds as well as government issued bonds. So this one here is very similar to the one we just looked at. These are very similar. I think if you look at the holdings, and I wonder if this is going to give me, I don't think it gives me the duration, but these guys here are looking for maturities greater than 10 years. And you can see that the rate of interest is a little higher because probably they're taking on a little more term in their bonds. And this is the one that I'm buying into. As mentioned, in looking at bonds, I look at this bond information, or I should say interest rate information that's based on the treasury bond yields. because on days when I see green, this means the yields are up and it means the price of bonds is down. So I like to buy when the price dips a bit, buy some, and then over time it rises. So that's what I'm looking at there. Again, bonds have been working for the past year. It's not like, hey, it's like a savings account where you put in $1,000 and that $1,000 doesn't move at all. No, it's not quite like that. It goes up or down a little bit. But now that we have, in general, rates that have been dropping, in general, bond prices go up. So bonds have been having a good year along with stocks. So that's bond investing via ETF. I think it's pretty easy to do it, and you can get out fairly easy as well. So if you maybe put some money away, and you're like, hey, I want to lock in this good dividend rate, not a bad idea. And then if there comes a day when I want to take that cash and do something else with it. I want to do something else with that capital. I want to put it in a set of stocks that I found that are great, or some life event came up. Hey, I want to buy this property and so forth. You've got that capital that's easy to get to. It's not hard to sell these ETFs. So that is LQD. Good luck with your analysis of LQD. Next one is XLP. So this is Consumer Staples Select Spider Fund. Done really well for the past year, 18%. So this ETF is going into consumer staples. We'll see the holdings that they have: Procter and Gamble, Costco, Walmart, Coca-Cola. So these are products that people will buy if there's a recession, no recession, whatever it be. They're going to need these products. Very good rate of return, very consistent. Over the 5-year, it did 37%. So consumer staples are not going to, be a big accelerator to your wealth. They're going to be a protective mechanism in your portfolio where you can, preserve your portfolio, especially in a down market. What I would say is I've had concerns that the economy is slowing down, and that's a fact. It's slowing down. It hasn't slowed down so much that we're in a recession, but the thoughts of that slowdown, I'm not the only one thinking that. The market's thinking that as well. And that's why more people bought into staples. They're like, hey, we sense that the recession is on its way. Let's buy into a class of stocks that's going to do well in a recession. So they bought into consumer staples, driving up the price of consumer staples. But over the 5-year, you could see that it's had a good year, but over 5 years, your rate of return is about 7%, and that's not setting any records. It's okay, but most of these pay a dividend, so it'd be 7% plus an average dividend for this ETF would be 2.5. So you're looking at 9.5 rate of return, very respectable. And this particular industry and sector, I should call it a sector, not an industry, it doesn't really go down all that often. It tends to go up most of the time. Now, if we have either a recession and then we get into a growth, period for the economy, you would see consumer stocks be sold off, and you would see the values of those stocks go in the red, because the market's moving from, hey, times are bad to times are good. Times are going to be good for growth companies, and I'd rather buy a company that has an exciting product. It's an exciting growth company, and we're off to the races investing in those companies. We're going to pull money away from staple stocks. So this isn't a bad idea right now, because there's still concerns that we got a recession to deal with. It's expected the recession isn't going to be all that bad. When you hear the language around soft landing, that's what they're referring to. I agree with that whole expectation that, hey, we're going to have a soft landing recession, but we're going to have a recession. and we'll see how it happens there. So good ETF with consumer stocks. Let me move on, and I want to check off Advanced Auto Parts. It's one that I meant to cover yesterday, but it slipped my mind. So let's take a look at Advanced Auto Parts. There it is, Advanced Auto Parts, AAP. So AAP. So this is down 28%. What's interesting is, so Advanced Auto Parts is down, but I forgot the other auto parts company. It's really done well. So, so Advanced Auto Parts down 28%. So car prices have really gone up, and especially 2 years ago when there was scarcity in the market, there was supply chain issues, so the dealers were sitting on low inventory, and they took advantage. I wouldn't say take advantage; they just reacted by. Thanks, Mike. AutoZone. That's the company that I was thinking. I'll compare Advanced Auto Parts to AutoZone. So car prices really went up fast. And especially the lower end consumers really beginning to struggle. They don't have enough, and their credit card balances have gone up, and there's been some default rates go up on credit cards as well as car payments. Where I'm leading to is, as you see the consumer struggle, that you can't buy a new car, they can't lease a new car, where they're going to have to maintain their current car. And that really helps companies like Advanced Auto Parts. It tends to be a good recessionary stock because in recessions, people will do more with less. They'll be, hey, I'm not going to buy a new car this year because I'm not feeling optimistic about the economy. I'm going to wait till next year or the year after and really hold off as long as I can before I get a new car. So let me take a look. All right. So the company is 2.4 billion, and so Advanced Auto Parts provides automotive replacement parts, accessories, batteries, maintenance items. Okay. And it's consumer discretionary. I would argue that. I think it's more a consumer staple because, if you need your car and the battery goes out, you're not going to be like, oh, what's discretionary? I'd rather not, have a new battery. No, you need a battery. You're going to go buy a car battery to get your car to start and get yourself to work or get yourself to school or get yourself to where you need to be. It's really discounted. You have an $11 billion revenue company, and they are selling at 2.4 billion. Why is it the case? Forward P is really attractive at 15.8. They paid dividend of 2.47, and they have a hold by analysts, but it's saying that it could be discounted by upwards of 36%. So what's going on with the business? So top line looks okay. You could see, again, back a few years when car prices were going through the roof, they really grew their business nicely. Now, they are losing money in the most current trailing 12 months. Let's take a look at the quarterly results. And the last quarter wasn't too bad. It was down slightly. So okay. So but here's a quarter that was really bad. I guess this is what really scared everybody. It's like, what happened to your revenue? Okay, so we have a company that's losing a little bit of money. In the past, they've made really good money. And I'm looking at the wrong line, excuse me. But in the past, net income was doing really well a couple of years ago. And the net income has really dried up. Wow. So it's really hit a downturn. So that's going on there. cash flow. Cash flow is looking good. It's looking really good. 352 million. And you can see that they had a dip, but it's come back. And a couple of years ago, holy smokes, 817 million. This company's worth, $4 to $6 billion. If they don't have a debt problem, let's take a look at their debt. Their debt can really spoil the whole stew here. So cash is 479. All right. And then total debt, 4.4 billion. So they have about 4 billion net debt. And let me take a look at their EBITDA. So they do have a debt problem. So their EBITDA is 359 million. Their net debt's about 4 billion. It would take them, like 12 years to pay off their debt. So that's part of the problem, is too much debt. How did they get themselves into so much debt? Did they acquire a business, or how did the debt level get so high? So their debt level is so high that I wouldn't invest in this company, because debt is really bad. And I'm going to go back to the income statement a bit, but I just want to study the debt a little bit. No, they've just had a big debt level for a long time. That's bad discipline. They should have been paying that off. So debt being that high, it really shows up in the income statement. Let's look at interest. Interest expense. So here's interest expense, right? When you had really low rates, you got a lot of debt. You're still paying some money, but as interest rates rose, it doubled that cost. They're paying a lot of money in interest. And now they're kind of somewhat captured by their debt. It's very hard to get out of that debt. So this stock is undesirable to me, and it, all the other fundamentals point to, hey, this is discounted, but this is discounted for a reason. It's got too much debt. It's got $4 billion of debt. If I value the company at $6 billion, I'd have to decrement, and that's a very favorable valuation based on their free cash flows. As you guys know my model, I decrement debt. I would be reducing that $6 billion valuation by $4 billion, bringing it down to $2 billion. Very quickly, it's not a discounted company for me. And it's a high risk company. That debt level, can they grow out of it? Not really. They're in an industry where you saw their modest growth. Their best year was 8-9% growth. So uninvestable for me. I think it was AutoZone was the other company that, is it AZN? AutoZone, AZO. Okay. This one here, this AutoZone's been doing great. Look at that. Holy smokes. Beautiful. $52 billion valuation. Holy smokes. Let's take a look at their debt just to see how much debt they're carrying. $300 million in cash. Total debt, $12 billion. Okay. So how much EBITDA do they have? Maybe this industry carries a lot of debt. They have $4.2 billion of EBITDA. So they could pay off their debt in roughly 3 years, little less than 3 years. So they can really afford the debt that they're carrying far better than Advanced Auto Parts. We double check that total debt. Yeah. So they could pay off their debt in less than 3 years. So their balance sheet's okay. They have taken on more debt. They were 8.4 billion in debt in 2021. Maybe they've opened up additional stores and have taken on some debt to make that work. So big difference there in two companies. This company is doing great. Their stock price is really moving. It's down quite a bit today. Let's take a peek and see what the markets are doing. So markets are up. VIX is down. Okay. Asia's still going. Okay. So that was Advanced Auto Parts. I owed it to a viewer. Let me check in on comments. So good morning, Tomas. Very good to see you. I believe you're in Argentina, if my memory serves me right. And I think your comment was a dividend about 1% sector. Huh, interesting. That's an interesting point. And then Mike, AutoZone has done well. Yeah, I mean, AutoZone was a brilliant buy a while ago. So Trader Prad, good morning, sir. Very nice that you joined us. I imagine Trader Prad, it's a calm Tuesday. It's a calm market. In China, it's a different story. We're going to look at that next. But I imagine calmness is not goodness for you. You're probably like, what the heck, man? Like, I need to see some volatility to take advantage of stocks that are moving up or down. So it'd be interesting to hear your thoughts on that. All right, let's take a look at Alibaba. According to Hawker 1000, Baba is ripping. So Alibaba, in a lot of ways, 6%. Wow. So what's the story? What's going on in China? So this is 38 minutes ago. Impressive shareholder yield. So this is interesting. A discounted free cash flow model indicates Baba's discounted by 40%. Yeah, I agree with that. I'll show you my discounted free cash flow model. I own Alibaba. I believe if you look at their fundamentals, it's a very valuable company. They're a $223 billion company from a market cap perspective, and they do revenue of $130 billion. This is in US dollars. We'll see if, I think they do everything USD. They have really set themselves up to be easy to analyze for an American investor. So their PE currently is 23, not bad. And then forward P, look at that, 10% for a growing company. What is going on? So their growth has slowed because the Chinese economy hasn't been clicking on all 8 cylinders. It's slowed down. And when we look at the quarterly, growth is okay. It's not a high growth company. It is fairly big now. I showed that number. I think it was 135 billion in US dollars. Now, when I'm going to go ahead and go to my valuation model because I've already converted everything. And we'll take a look at. So all right, so Alibaba, and the only thing I have to update is my market cap number. I don't have that auto updating, and so the market cap is 223 billion. So when we look at Alibaba, and I'm going to update this discount rate, and Meta has been really cool at giving me weighted average cost of capital, by the way, which is a really intense calculation if you ever try to do it manually. I have. So, but Baba has been really good. Weighted average cost of capital for Baba stock. And I've tested Meta's AI's results with my doing it by hand on a Google Sheet. And they've been really accurate. So, hey, man, I'll take it. So you can see that Alibaba is saying that the weighted average cost of capital you could use for Alibaba is 5.39 to 8.5. Now, when I look at a company that's located outside of my home country, the US, I kind of pad the number, but it's probably padded too high. If there, if you look at it from a finance mathematical perspective, it should be about 8.3. So I'm going to go to 10. And I'm still going to put a premium on my investment here. Another way to think about discount rate is, what's the rate of return that I want? Okay, it's my money that's going into this stock. So that's the rate of return I'll accept. Interest rates are dropping. So my discount rates are going to begin to drop because the alternatives for my capital are not as I would say they wouldn't, risk-free rates are not as high anymore. So I can bring down my discount rate. But everything else looks really good for the company. Really nice free cash flows. This is all USD. And their terminal value is going to be excellent because you think about China, it's a big country with lots of people, and they are building a middle class. They are really creating a strong economy. It is the second largest economy on the planet. And some people expect it's at some point going to be larger than the US because they just have so many more people. So Alibaba has a lot of addressable market. Their space is expanding, their industry is expanding, and they are expanding with it, and they have more room to grow. Being big in this industry does give you advantages. When you look at Amazon, it's got a huge advantage: brand, size, scale, efficiency. All those things apply to Alibaba. So the company, to me, from a qualitative perspective, very, very good strategically. It's a very good strategic company. I think they have a market that's going to continue to get bigger, and they can get bigger with that market. They are also presenting themselves to the U.S. Consumer as well as U.S. businesses that want to buy from Chinese companies. I think that's a really good idea. No big, I don't think I'm surprising anybody by saying a lot of companies here currently buy from Chinese companies. So just having a channel where businesses in the U.S. can buy from businesses in China through Alibaba, very good move. And I think they have the right structure and presence on both countries to be able to provide that. So Angela puts out a comment: I don't trust Chinese stocks and information. When you deal with other country stocks, that's one of the risks. So I'm going to call it a risk. Now, is Alibaba, do I believe Alibaba numbers? Yes. Do I believe the Alibaba story? Yes. Do Chinese stocks carry a discount just because they're in China? Absolutely. So my expectations is the market's never going to value Chinese stocks like a high flying, stock that's maybe headquartered in New York City. It's just not going to be the case. That's not my expectation. But you could say the same thing, like I have a company that's predominantly located in Mexico. Great company. I don't ever think that stock's ever going to be valued as if the company was headquartered in Chicago, Illinois. It's just there's a discount when you go out of the country for this investor and for many investors. So I agree with that. I think some stocks, some stocks in the, are very reputable, and Alibaba is one of those stocks that's very reputable in my mind. That's why I'm an investor. If I did not believe in their numbers, I would not be an investor. But I do believe in the Alibaba numbers. Having said that, the numbers just really look good for the company. And, the stock price, I believe this one updates automatically. I'm still looking at a 44% discount. Now, has been an investment that's taken a little too long for it to really begin to work, right? So here's Amazon. I own two. No, that's it. I'm looking at Amazon. Wrong stock. Here's Alibaba. I own $38,000 of it, and I'm up 21%. But a lot of that is probably today's appreciation, and it's not even valuing today's price because this is the closed market. So this will be a little better. It just has seemed like Alibaba has taken a long time to get going from an appreciation standpoint. And it's been good information. I don't, this is the only Chinese stock that I own. It's really been trimmed down. The sell off in Alibaba was incredible. 80% of its value went away. And it had a nice rally. And then it collapsed again. So Alibaba, the late, great Charlie Munger was an investor in Alibaba. And this was one stock that surprised him. And you look at Charlie Munger, he was exceptional. He was kind of a rough around the collar, kind of just said exactly what he was thinking. Sometimes he would say very rude things, but he did his homework, and he did his homework on Alibaba, and he was a big investor. Over the last year, it's up 8%. You can see this is when it's really moving. And I don't think this takes into account. Okay, yeah, it does take it into account. Okay, cool. So for the last, call it 1, 2, 3, the last 3 months, the stock's up 32%. And that's what I was going to mention is you could see that, it's defied kind of its valuation. For a while, it was like just not going anywhere. And in fact, it was down not too long ago. It was down 20% in the span of like 7 months. And I would just shake my head because everything else was going up. Baba was going down. I'd be thinking, well, what is wrong with this stock? Nobody likes it. It's just being left out of the big rally, but now it's beginning to pick up some heat and really going places. Glad to see it. So go Alibaba. The other stocks, and what's going on in China? What's the big story? Do you guys know the big story of why their stock market's really cranking? Did they have like their economy's growing really fast, or what's the story that's driving? Let's see if we can do a Google search on that. So let's see, the China stock market. Oh, this didn't really help a lot. Yeah, I'm not getting the story on why Chinese stocks are just booming today. Overall, so just looking at the facts, right? They cut rates. Is that what they did? Trader Pratt thinks they cut rates. Okay. Interesting. Well, that caused a pretty good rally in the U.S. So I guess the combination, because China depends on other economies in the world, one of them being the U.S. So If the US is cutting rates, that means it's going to stimulate growth, which means we're going to buy more products from China. And if China cuts rates, that means they have lower borrowing costs. Their economy is going to start doing better. So I think the combination of the two, that's probably just creating more enthusiasm and optimism for their economy. So very good day for Alibaba. Um, it's fading a little bit, but it's good to see that they're up over 5%. Go Alibaba. And I'm buying into Amazon. I'm not buying additional shares of Alibaba. Alibaba is my single Chinese stock. I'll probably hold at this position, just kind of, sit on the stock for a little while, see what happens. It is a nice diversification play to being a Chinese stock because most of my stocks are US based. But I continue to buy into Amazon, even though Amazon doesn't provide as great of a discount as Alibaba. If you look at their valuation, I think the fair price for Amazon is $210 and they're trading at 193. Where Alibaba, there's a bigger spread between where I think fair value is. But there's only one Amazon, and man, I had a big position of Amazon. That's been my biggest regret for the last year is selling that position. I took the gain and regretted it. I kind of wish I owned $200,000 of Amazon now, but oh well. I'm going to have to build it up. And lesson learned: don't sell great companies. So I'm going to build out my position in Amazon and concurrently own some Baba because that is a play on China. Um, so other companies. So JD, let's look at JD. JD, I think, competes with Alibaba. Right. Yeah. So they compete in some categories against Alibaba. It is smaller cap than Alibaba. The revenue is impressive. Look at their PE ratio is 10 and then a 7. So Chinese stocks are discounted compared to American stocks. Some American stocks have PEs that are like so high, it's freaking stacked. Hey everybody, my internet went down. Give me a second here. Can you guys hear me now? All right, cool. All right. So it looks like I'm back. Okay, so we were getting into JD. JD is up 8%, and let me add that to my screen. All right, cool. Sorry about that, everybody. Internet. I've got this fiber internet, which I've loved ever since we got it. It usually is pretty rock solid, but here I am, went down 8%. JD's up 8%. Interesting that the market's rallying this much. I think the Chinese market does have a lot of room to go up because stocks like JD, I mean, I just showed you Alibaba that it's had really big sell-offs, and it hasn't been doing all that great. Let's see what JD's been doing. Similar, right? So you got stocks. If you look at the big picture, right? China is a massive economy. These companies, in a way, I think it's the way I observe it is they get a lot of ideas from other parts of the world, specifically the US. The way that Baba functions, JD functions, you could probably see that Amazon did that a while back ago, or somebody else did, right? You have like TikTok is an amazing growth story, but that's kind of like Snapchat. that's something that happened a while back. So they kind of replicate some of those ideas, and it works. Hey, there's nothing wrong with taking a good idea and running with it. And I think these companies are basically taking the ideas that have worked in the US or Europe or somewhere else and saying, hey, if it works over there, let's try it over here. And I think it's a good idea. It's a good business plan. But the stocks haven't been going up all that much. Meanwhile, the US stocks have just been cranking. I mean, they're up and to the right for 2 years. So my feeling in the US is stocks are expensive. Wouldn't be surprised if we had a correction. Wouldn't be surprised at all. Where on China, I wouldn't be surprised if they had a pretty long upward trend, because U.S. investors are one thing, but there's investors all over the world. And I think U.S. investors, a lot of them are okay investing in China. Like I was talking about Charlie Munger being an investor in Alibaba. I think there's Japanese investors that invest in China. There's all kinds of, Middle Eastern companies invest in China. China is a partner to the world. I know we have tensions with the US and China, and I think the geopolitical theater that we see is quite interesting. And I think that causes, investors like myself and US investors to be cautious, not own too much. But there is opportunity there. I would say that, if this thing persists, like if we see the Chinese government continue to help the economy get better, I might start changing my perception of Chinese stocks. I may have to kind of ride that trend up, but it's good to see that they're having a good day. JD is a growth company, I believe. Let's take a look at their growth. Well, it's kind of like what Alibaba had been showing. It's already a big operation, but if the economy begins to grow, this should get a little better, but not, dramatically better. It'll just be a growth company. The PE is very attractive. Alibaba didn't show it, but Alibaba has no debt problem. Let's see what these guys are all about. So they have, and this is all in the Chinese currency. I believe this is 0.17 to, it's worth 17 cents for every dollar. So total debt. So they have more cash than debt. So they're really a no debt company. So very strong balance sheet. Very good to see. They've taken, when you look at the financials for Alibaba, and I haven't looked at JD financials, but Alibaba's financials are as they're probably at the highest tier. Like some companies provide financials and earnings releases that are quite simple. They don't tell you much. And I would give those a C minus. Like, okay, it passed. You gave me everything I needed, but not much more. Then you have earnings reports where it's a true partnership with investors. Like, hey, we want to tell you all things that you should know. Alibaba is like an A grade. They do a very good job of giving you the financial data, which is a requirement. You have to do that. But they also tell you about the business, the good and the bad. They've come out and told us the bad. That's a partnership with the investor. I like Alibaba for that reason. I think they're very transparent. I don't know about JD. I would hope that they have the same culture within the company to really be transparent and really be in partnership with the stockholders. But JD is in a similar business as Baba. It's doing really well today. See how it goes. Let's talk about NIO. NIO is an electric vehicle company. And I don't like the auto industry. I think there's better markets for me to be an investor in. But let's just talk about who's going to win the EV war. And China has huge advantages. They have a labor advantage. They have an ease of doing business for an auto manufacturer. So batteries, right? They require manufacturing that's, either it's very toxic. It's environmentally, here in the US, we really protect the environment, as well as in Europe, they really protect the environment, which is, I think, a great idea. Well, in China, they're a little more relaxed. From what I understand, I could be wrong, but I think that gives them an advantage. It gives them an advantage from a labor cost perspective. Their supply chains are there. A lot of our parts that end up in vehicles here in the US, they're made in China. So they're locally sourced for the Chinese manufacturer. So I think NIO has a lot of advantages. And I think that NIO, as well as other car brands, are being sold in parts of the world that are building out their middle class. Other parts of the world, right? Like the standard of living in the US is excellent, and people can pick from a variety of cars, whether that car is $25,000 or $250,000 and everything in between. Where, developing countries, somebody may have, saved up for a while to have $10,000 to buy a car. Well, they could buy a brand new EV from China for that price. And that's going to be that's a big addressable market. Huge. So NIO is going to do well for the next 10 years. And it's not necessarily going to show up in the US, but it's going to show up in Latin America, Africa, Asia. I mean, everywhere where, the middle class is being built out and people are buying a vehicle, NIO is going to really work. You think about India. India has a huge population, and a lot of folks in that country, they don't have as much discretionary income. So buying an EV that is priced at 10 grand, that's a pretty good proposition, as opposed to 40 to 60 grand, if not higher, based on the prices that I see here in the US. So I think NIO's got a big expanding addressable market. It has a lot of room to grow. So big picture, qualitative, NIO has a lot of advantages. I'm not a buyer in NIO because the auto industry, to me, I think some investors will say, and I'm going to talk about Tesla. Hey, Tesla is a tech company. Okay. Let's talk about it for a minute. A tech company is really like Google, where Google developed the Waymo platform for robotaxi. And then they partnered with a car company, Jaguar. Jaguar brings the car. Google brings the technology. That's a technology company. Tesla manufactures cars. At the end of the day, that's going to hold them down for a long time. And I think that I'm not going to go as far as saying that a car company is a tech company. If they manufacture their own cars, they're doing something that has been performed for over 100 years. It's an absolute mature industry. There's competitors everywhere. So if I'm going to invest in a company and they do have manufacturing capacity to make cars, it's almost a non-starter for me. It's just too competitive, too many things can go wrong. You manufacture the car wrong, you lose market share. You're constantly, it takes a lot of capital to have these factories, just on and on and on. Wouldn't it be just be simpler to buy Google? Wouldn't it be simpler to buy a true technology company that creates the intellectual property, the idea, and has a patent on it, and then sells the idea to a million customers and has an incredible high margin rate? That's a tech company. Neo, Tesla, if they're selling cars, I would give them that. They're very advanced cars. I'll give you that. But you got to make a stinking car. And when you make cars, it's very hard. It's very difficult. Um, so I'm staying out of auto, and we'll see. Neo might be worth 100 billion in 5 years, and I will tip my hat to all those investors and say, congratulations, you made all that money. But I'm going to bet on other types of companies. I owned Ford for some time, and it just did not do well for me. I didn't lose a ton of money on Ford. I think I made a little bit of money, but it was underperformed based on my goals of a stock, which is it needs to double every 5 years. And Ford came well short of that. Well short of that. I thought for a while it was going to be that type of stock, but it just didn't materialize. GM was a better pick, but I didn't pick GM. And Tesla's certainly at times been a really good pick, but I just don't believe Tesla has a valuation that could be sustained. I think Tesla is actually grossly overpriced if you look at it as a car company, which I do. So Neo looks like it's going to be doing well from a growth perspective. It's already growing nicely, 30% growth. And I think they could accelerate that growth because the addressable market's so damn big. So we'll see. They can become a high growth company and be an exciting company. It's a low market cap. $12 billion. Jeez. Tesla is how much? 700 and some odd billion. And let me tell you, Neo's coming after Tesla. This, I don't have a dog in the fight here, but strategically, Neo's got more advantages than Tesla. And the whole technology advantage that Tesla has, at the end of the day, I've seen robo-taxi technology that's being developed in China online. And I've seen like self-driving technology. It's pretty damn impressive. The Chinese development, I think capacity, they're the real deal, man. I think they're coming after Tesla. So they have a lot of upside on their business. So we'll see how they operate. I don't think they have a debt problem. Let me make sure they don't have a debt problem. So cash, and this is in the Chinese currency. They have a lot of cash. And they have as much cash as they do debt. Very good. Very good discipline. So, yeah, so we'll see how they operate. I'm going to do a deep dive on Neo just to take a peek at it. And just maybe it'll be interesting to know that. Then there was one more Chinese stock, BFLY. Butterfly Network. So I don't know if we're going to look at the stock, but maybe I noted it wrong. It seems like these guys are in the US. So this is a healthcare company. Yeah, they're in Massachusetts. So got my wires crossed. Sorry. This is just a good healthcare company doing med devices. So Butterfly Network develops, manufactures, commercializes ultrasound imaging solutions. Okay. It offers Butterfly IQ, a handheld single probe whole body ultrasound system. Okay. So veterinarians. So if they're trying to look at an ultrasound for a dog or a cat or a pet. Okay, interesting. This space, for a long time, there's been some big players like Siemens and General Electric. This is a small cap. I like this space. I like this space a lot. Um, 71 million revenue. They are losing money. How long they've been around? So they've been around for 5 years or so. The stock's really, really depleted. And their revenue. So revenue had been expanding very nicely, and then they started to lose revenue. They started to grow again. Interesting. So if you look at Q2 24 compared to Q2 23, they did grow. Looks good. They're still losing money in the quarter. So they burn cash. They continue to burn cash, but they're burning it at a slower rate. Okay. Okay, so they're burning cash. How much balance cash do they have on balance sheet? They have 100 million of cash, and they don't have long-term debt. They have 24 million in debt, so they have 77 million dollars of cash. They're burning 10 million a year, so they have plenty of cash to operate with. Okay, they're not going to run out of cash. So this one here is, not ready to take off, but it has enough there where if enough homework is done on this one and you're seeing that, hey, the adoption rate of their product is really going somewhere, and they continue to grow at it, maybe they start to grow at a 20% rate, 30% rate, they're showing that their metrics are getting better, like they're burning less cash, they're becoming more profitable. This could be a really good buy, but there's risk, right? One of the things, a stock gets to $1.75 per share for a reason. There's been bad news, bad performance. A lot of people are believing the company is going to fail. They're going up against big competitors, Siemens and General Electric, and I forgot which GE company ended up with the imaging technology or imaging business. Those are really, really strong players that are really entrenched in the healthcare complex. So this is an interesting company. It's a pass for me because they're just not ready for prime time, and it's not exactly the industry where I did work at a pharmaceutical device company. I have worked with some companies that do med device, but nowhere I don't have the expertise to be able to say, hey, I really understand this industry really, really well and think these guys are going to be really good in 5 years. That's not the position I have. So it'd be a pass for me. And it's encouraging to see them do better. And hopefully, this stock's doing really well in 2 years. But we'll see. I wouldn't be surprised if they are completely gone in the next 2 years as well. That's why the stock's trading at $1.75 per share. So that is I think that's the last one on the list. All right, we covered all those. Let's take a look at the market. The market is selling off a bit. The Nasdaq's down a little bit. S&P's down a bit. The Dow is up a little bit. Interesting. Okay, so overall, I mean, the market's, the 5-day looks pretty damn flat, right? You look at since September 19th, so going into last week to this point, I mean, it hasn't moved much, which is kind of making for a boring market. But again, for the past month, it's been a good market. I'm doing better than 1% for the past in the month of September, because we have had a really nice rise. We've had a very good rally of 7.32% since September 6th. So I'll take boring for the next 5 trading days, and then I'll be able to bank on the gains that I had for the month of September, and we'll head into October, see what that month has in store. All right, so let me catch up on some comments, and then we'll call it a stream. And Mike, thanks for showing up. You bought NEO in 2021. Didn't do too well on it. Might do some tax harvesting. Good idea. We're getting around that part of the year, right? When you start looking at your taxes. I sent out my prepaid taxes 2 weeks ago. So I do quarterly prepayments because last year I made some good money, and the government said, hey, congratulations. Next year, we'd like you to send us these amounts on these dates. So good deal. I'm all for paying my taxes, especially. I'm all for making money. I'm all for paying my taxes. So you're holding Mr. 123 Cheetah. You're holding NEO. Good. I'm glad to see the stock's working for you today. Good luck with it. And too much volatility. How much volatility can you expect in bonds? So that's a good question. So, all right, Trader Pratt, I'm going to get to you in a sec, but let me go over something that I think is important to keep in mind on bonds. So the 10-year is probably the most referenced yield that you'll see. And really the last 5 years has been historic. If you look at the last time we had this type of action in bonds was in the 80s. And I remember my mom bought a house. I was a little guy. And she bought a house and she was paying like some crazy interest rate, like 15% or something. And that's because interest rates in the 80s were like really high. And that was kind of normal. And then over the course of time, interest rates have really just gone down. You see that? I bought my first house in 1994, and I kind of caught, the market was probably around here. I remember getting a rate of, I don't know, 8.25. And, the people that I looked up to and gave me advice were like, hey, that's a really good interest rate. And I fixed for 30 years. Oh, awesome. Well, you fast forward, interest rates went way down and down to less than 1%. As interest rates fell, so did bond values. So you could see that there was a long bear market in bonds. But then things turned around extremely, extremely fast. When you were buying bonds and they had yields like those ETFs we were looking at, if you looked at them and you bought them in 2020, those ETFs would probably be saying, hey, we can give you a dividend of like 1%. And you'd be like, okay, that's underwhelming. I'm not going to buy. I had literally zero capital in bonds in 2020. Uninvestable. All downside, no benefit. Why would I lock up my capital and make no money? And then we had this rise in interest rates. And when that happened, it just punished the stock values, bond value, excuse me. And now we're seeing a decrease. Okay. So back to, is it volatile? So historically, no. You're going to see subtle changes in bonds. You're going to see, and I think going forward, we're not going to see drastic changes like we saw from 2020 to 2022. The Fed had a mission, which was, holy smokes, inflation's at 9%. We got to slam on the brakes. And they started raising interest rates, if you recall, just one after the next. And it caused the bond market to really change dramatically. And it drove Silicon Valley Bank. It caused a run on their bank. I don't expect that to happen. So that's the only thing I would say is that was a very volatile time. Going forward, I think we're going to see a little bit more of what we've seen since for the last 2 years, which is you have a little ups and downs, and you may look up and say, "Oh no, my ETF is down 4% over the last 6 months," and then you give it 6 months, and you're like, "Oh, I'm up 2%. Oh, I'm down 1%. Oh, I'm up, 1%." So that's the kind of, if we look at the ETFs that we were examining, I think one was LQD. So it did have a pretty good move back here, but then after that, it's kind of nice and boring. So from here to here, it's 2% over the course of 9 months. And that's what I'm talking about that's what you would expect out of a bond ETF. It's not moving much. We had a lot of fireworks 2 years ago, but from now it should be a little bit of this. Might go up a little bit, might go down a little bit. As interest rates fall, the value of this ETF should rise. And that trend is expected. That the Fed has already communicated, hey, we reduced interest rates by 50 basis points, and we expect we're going to do it again this year. And some investors believe we're going to go down 75 basis points in addition. So whether we go down another 50 basis points or 75 in 2024, we'll see what happens there. And they've already communicated next year we're going to reduce interest rates. So as you have a declining interest rate, this bond ETF should go up in value because it's locking in yields on bonds. It's in its ETF. So those things far more stable than the stocks, and that's what I'm seeing out there. So, and then yeah. So Trader Prad's a little older than my older son. He was born in 2000, but I guess you got 6 years on that kid. And yeah, and a dip in bonds is not like a dip in stocks. A dip in stocks is like, holy smokes, it's down 40%. Bonds, it's like, oh, great, it's down 3%. I'm buying. It's down like 0.5%. Hey, man, go time on bonds. So it's a very, very different, frame of reference. All right, so Trader Prad looked at Palantir. And Palantir is interesting company. I think it's overpriced. It's down today. Okay. But it's been rocking, man. This stock's really worked. 159%. Look at that. Amazing. So their stock has been amazing. But as mentioned, what is not amazing is their fundamentals. Their fundamentals are good, but not amazing. Amazing is 100% growth. Good is 21% growth when you're a $2.4 billion company. So the stories that are being told about Palantir, oh man, they're doing this stuff, big data and all this awesome stuff. Hey, that sounds great. You talk a mean game, but revenue growth is saying that you're a good company. You're growing. You're not even keeping up with Meta. You're right there with Google, and Google's massive. Like Google Alphabet's massive. And I'm not exaggerating, Google's up like over 300 billion, I believe, in revenue. They're just massive. So if you want to like be put in the category of amazing, you got to start growing at 80, 100% if you're this small. That's the beginning of the thesis that I've built on Palantir that, hey, it's just so overpriced. If they cannot start to grow faster, I think investors are going to go away from that stock. And today it's going down. And that's a stock that you're trading on. I'm gonna attend so Trader Pratt has a stream. It's at 8 p.m. Eastern, 5 p.m. Pacific. I'm gonna attend today because I'm very curious to see what his thoughts are on Palantir and Snowflake. Snowflake, again, their stock has really been beaten up. I think it's been beaten up pretty good. So this one's got a different scenario altogether. It's down 26%. When you look at from the top to the bottom, it's down 53%. And that's over the course of 7 months. Whew, man, pain and suffering. And when you look at our friends at Snowflake, they're growing nicely, but they have a big problem, which is Snowflake has been involved in some pretty terrible hacks. And I think AT&T was part of one and a couple of others. And that is not good. It's terrible. And I'm trying to find the stories, but they're out there. So it's a $37 billion market cap stock. It's a little bigger than Palantir. It's 3.2 billion. Looking at the quarterly, growth is slowing down. This is still a pretty impressive number, but I think there's a qualitative analysis is what's going on with Snowflake. I know those stories that, hey, there was hacks that were related to them. They were involved. There was their software that was hacked with some big companies, Live Nation, AT&T. My recollection was those two companies. Do your homework on it, but that's what's been going on. It looks like it's selling off today. So, all right. So Mike, so Chinese markets are surging. Yeah. China unleashed powerful policy combo to support the market. Cool. Very good. Very good. That's traveling to China is on my bucket list. I'd love to go, and I'd love to go to Japan, and I'm sure I'm going to get there someday, but we'll see. Snowflake announced a $2 billion convertible notes. So they're taking on debt. Interesting. Why would they need debt? They make money. Yeah, that's just one more thing to be concerned about is growth tech companies don't need to issue out debt. They usually have cash coming in. Their initial public offering provided so much capital. They don't need any more capital, especially, during the debt market or using the debt market. Companies like Meta and Google and Alphabet, Microsoft, it's hilarious because they take on debt because it's offered to them at such low rates that their CFOs, it's kind of like their arbitrage opportunity. Yeah, hey, we'll issue out debt at 2%, 3%, and then we'll take that debt and buy some instruments and make 5% on it, and overall we generate a 3%, profit on it or something like that. But they don't really need the debt for any business purpose. Where Snowflake, I think there's been several big qualitative news stories that make investors worried about, the future of Snowflake, or at least customers are going to be apprehensive. CrowdStrike, I put in the same, kind of boat. Where's CrowdStrike going? So it's down 2%. And of course, CrowdStrike's been a disaster. It's still up 76% in the 1 year, but it really fell off a cliff recently. And so CrowdStrike had caused the biggest outage in the history of computing. So they have a title that nobody wants, and they went down fast. And they've begun to rally. Now, the story they've told, the market is, hey, it was just a quality issue. We released some software that was bad, and we really sorry. I think they gave everybody $10 or $20 credit so they can, I don't know, go buy a couple cups of Starbucks or something. They're a good grower. Now, the stories behind CrowdStrike have been, oh, this company's amazing. They're the best enterprise security software company. And maybe there's a lot to that. But when you cause the biggest outage in history, it's going to cause Microsoft, especially, and the other software companies that basically worked with you, because CrowdStrike does the security aspects of the whole software enterprise. But the big enterprise players like Microsoft are basically being taken down because of this CrowdStrike issue. It causes Microsoft to then think to themselves, I imagine, we got to develop better security software because we don't want third parties like CrowdStrike to ever do that to our customer again. That's just a natural, logical thought. That's the biggest problem I have with CrowdStrike is you just gave every other massive software company like Microsoft real good reasons why they need to eliminate you from the ecosystem. They cannot depend on you. If CrowdStrike causes one more outage of that magnitude, it's going to destroy the stock. But Microsoft's going to have harder conversations with its customers. Like, dudes, it was the outage happened in 2024. It was horrible. Like some companies, I think the airlines really suffered. Delta is trying to sue CrowdStrike, and across the board, there was so much disruption and so many dollars, basically wasted. It cannot happen again in the near term because Microsoft's a $3 trillion company. They're probably fast tracking, okay, how do we create better security software that is inherent in our operating systems, that's inherent in our operations, so that we minimize the exposure to CrowdStrike, because we just don't want that risk. If anything, from a PR perspective, we cannot take a PR hit where we have another outage because, first time around, I guess customers would be accepting of, okay, well, Microsoft, we don't blame you. We blame CrowdStrike. It's terrible that it's coupled to your software and it took you down as well. But if it happened again, it'd be like, Microsoft, what the hell, dude? Why do you keep depending on CrowdStrike? So, Trader Prad, did you know CEO CrowdStrike? Same guy, Cisco, as CTO. I think I heard that. And I think the caused an outage. So he has a record of doing this. Man, the other thing about so Jim Cramer, he's a, what do you call it? A lightning rod for comments, right? Some people love him, some people hate him. I'm like in the middle. Some things I really gleam out of his thoughts. I think he's one of the best at telling you where the sentiment of the market's at. Just that's what I take out of it. One of the things that I dislike about Jim Cramer is he has this cozy relationship with CEOs. And sometimes it's just too positive of a love fest, a bromance that he has. And he had a bromance with the CEO of CrowdStrike. He loved how the CEO raced at, I think, Le Mans 24-hour race and so forth. It's like, oh man, I'm in love with that CEO. He's so cool. It's like, hey, Jim Cramer, like, we're investing in companies here, right? I want to make money. I don't care if the CEO is into gardening or race cars. I really don't care. And for you to have a bromance on this guy, really, to me, it felt like he kind of led a lot of folks down a track where it's like, hey, isn't the CEO cool? Maybe he is, whatever. Is CrowdStrike a valuable company? Do they continue to grow? Do they have a reason to exist in their economy? So it'll be interesting to see where CrowdStrike goes. It'll be interesting to see where Snowflake goes and where Palantir goes. It is an area, it's an industry that I've worked in for a long time, software. I have some knowledge of it, and I continue to grow. I continue to learn because these are really interesting stories of the time, and we'll see where it goes. So, looks like Shadow Guy is on a train, on a Swiss train. Cool, man. And that's from Stadler, which is a company you came up with recently. Hopefully, you have a nice ride. When I go to Europe and get on their train system, it's so cool. I traveled through Germany, their trains, and from what Shadow Guys shared with me is the Swiss train system is pretty amazing. I don't doubt it. I got to go to Switzerland and check it out. But my train experiences in Germany were really positive. Their train stations are like, the food's good. Everything's like so nicely put together. Italy, same thing. France, same thing. UK train system, really cool. The one thing I would say about the UK train system, people were so properly dressed on that train. I made a note, man, I got to like wear a nice business jacket and a collared shirt next time I'm in UK, man. People were nicely dressed and very proper. Italy, people were pretty chill, great. Germany, pretty chill, great. Not saying anything bad about UK. I just was impressed of how nicely dressed everybody was on the train. I've always wanted to visit Switzerland and ride the dinner train up the mountain. Cool. Yeah, I'd love to go to Switzerland. And we'll see when I get there. So, all right, let's take one last glance at the stock market. See, I'm still calling it a flat day of trading. It looks like, according to some of the stories, let me look at sector list. And materials. Remember, we've been talking about materials and industrials. They're having a good day, 2%. Energy's up. Oil prices are up. So no big surprise. Utilities are still going up. Utilities have been having a very, very good week, very good couple weeks. Real estate's up again. Real estate has been having a good time. Financials are down. Technology's down. Healthcare is down. Financials are down. Interesting. I'll have to take a look at that. So, interesting day. Communication services down a bit. So, interesting. All right, everybody. So, everybody enjoy your Tuesday. It is kind of a chill day from where I'm sitting. Hopefully, our stocks move up a little bit, and encourage you to visit Trader Prad. Thank you all for attending. I appreciate it. Please consider becoming a paid subscriber to the channel. The details on YouTube will give you a link if you want to consider it and take a look at it. It's $10 a month. And I am going to move the rate up in the month of October. And I'm going to spell out, what's included in the membership. If you become a member, you'll always become a member at that price, and you'll be upgraded to the highest tier automatically. But once I have the other tiers set up, it'll be pretty much whoever took advantage of being an early member gets that membership, and anybody who comes in after that will buy into the tier they want to be a part of. So everybody, thanks for tuning in. It was really interesting. Thanks for hanging in there during my internet outage. And I wish you a very nice day. I'll be back tomorrow, same time on YouTube or on Facebook if you watch me there. And everybody have a terrific day. Thanks for attending.